Thank you, Andrew, and thank you, Simon. Maybe a small part of Sage, but a rapidly growing part of Sage. I'm very grateful for it. There's 4 topics that I wanted to cover in this final session. I think in light of much of what we've discussed today, it is helpful and informative to take a historical perspective of our revenue mix. I want to share with you some of our early experiences of pure web-based businesses, including some of their financial characteristics. I'm going to then change tack and look at cash generation, how we've used the cash we generate, how we will use it. And, of course, that will lead to some comments on M&A. But as I say before that, let's just take a step back in time and look at Sage over the last 10 years. And what this slide shows, to be clear, is our revenue mix. It is not our growth. It's our revenue mix slide over the last 10 years. And I think the thing that jumps out at you here is the extent to which that mix has shifted to subscription revenues since 2001. And I think you'll agree that's quite a profound change. And why is this relevant? Well, as you've seen today, much of this web business that we're talking about doing, both online solutions and connected services, subscription revenues in nature. So these revenues will be manifest, of course, not in an initial license fee, but in subscription revenues for us. And, of course, many commentators have observed this to be a significant threat to a quote-unquote traditional software business. However, as you can see, Sage is entirely familiar with the move to subscription. I would argue more so than any other software business that is around today. We love the predictability it brings. We love the strong, dependable cash flows that attach to it. Now, a question I hear often in contemplating this mix shift to subscription revenues is, what about the impact on margins? What's it done to margins over time? Well, let's take a look at margins and how they've evolved as we've seen this shift. So as upgrades in particular have become part of support contracts. So consider the evolution of our margin over the same 10-year period. And what you can see today is that what you can see from the slide is it's fairly steady. Movement principally attributable to acquisitions. So clearly, for example, healthcare has contributed to that. So if for a moment, because we know the story with healthcare, we X out healthcare, we see the line is in fact even flatter, an even steadier margin line. And you see indeed the improvement in margins in healthcare have made that far less dilutive than it has been in the last couple of years to group margins. So my point is, before the impact, a material impact of the web, certainly pure SaaS, etc., on Sage's business, we've already embraced the move to a subscription model. Over a period when we've seen subscription revenues move from 40% of our business to 66% of our business, our margins emphatically have not suffered. Our margins, FY01, 26.5%, in FY10, 25.5%. So with that context, let's reflect on some of our early web experience. And to do this, I did a little bit of digging back into research notes, and I identified some of the common concerns that I read when I read people write and express views on Sage. So, subscription revenue model will significantly slow down the recognition of revenue. SaaS is typically a much lower margin business. Building SaaS products will be expensive and time-consuming. Now, earlier Joe demonstrated Sage 1, a product that we all feel pretty excited about, but as you'd expect from me, there's going to be some boring words from an FD here. We will update you at future results on the revenues that these pure SaaS products are generating for Sage. But, I'm going to have to counsel you not to expect those to be suddenly leap to be a material contributor to revenues anytime soon. However, clearly, as my colleagues have described, it is vital nonetheless that we have these products out there in the market. Notwithstanding that, I think the pricing of the proposition makes for an interesting case study. Sage 1 Accounts, with its 24/7 support, retails at £10 a month. The most comparable desktop product we have is Sage Instant Accounts, which retails for £115 for the license and support running at about £100 per annum on that product. Let's ignore the fact that quite often we don't see all of those license revenues because they go through a retail distribution channel. Now, entry-level products, critically, traditionally have had something like a 24% support attachment rate. So what I did here was just take 100 products over a 5-year period, and you can sort of plot the maths. And I'll be conservative for the sake of comparison. Let's assume that all of those customers that take a support contract on day one actually renew it over the 5-year period. We wish that were the case. Now, what it shows, notwithstanding that, is that not only is the 5-year value significantly greater, but in year one, we actually almost break even. And of course, the reason for this is that SaaS brings with it, effectively, 100% support attachment. That's the critical difference. So if we go back to the Foundations for Growth session earlier, David and I talked about how the web could lead to improved renewal rates. And as Joe and Santiago demonstrated, the renewal rates for SaaS products will be higher than we've experienced for desktop products, as effectively non-renewal is a turn-off of the service, something any sort of ongoing business clearly can't afford to happen. So in summary, we don't share this concern that subscription revenues will slow down revenue recognition, particularly, of course, because the adoption of these services in itself is going to be quite gradual. The second concern goes to margins. Often I read they're much lower in the SaaS world. Well, a couple of observations here, and people often, I've noticed, cite the NetSuite as evidence of this. Well, this slide comes from NetSuite, one of NetSuite's most recent filings. And the number I draw your attention to is that sales and marketing number there. Because what it clearly shows is that the losses we see here are principally attributable to the fact that NetSuite is spending something like 49% on average of its revenues on sales and marketing. Now, you'd expect that from a business that is building a brand from scratch, but not from Sage, not from a business already supporting 6 million plus SMEs with huge brand recognition. Let's stay with the theme and just probe a little bit deeper and look at gross margins. And again, let's return to this comparison of Sage 1 and Instant Accounts that I mentioned earlier. Now, clearly, if we compare the sale of one unit of each, there's a phenomenal difference in profitability. For desktop, clearly, you've got a media cost, some disk costs. For SaaS, of course, you've got the hosting cost. But I think what is interesting is how quickly gaining scale makes a difference. So after 1,000 customers have subscribed to Sage 1 in this example, the gross profit starts to look very similar to the traditional gross profit we enjoy in the desktop world. And indeed, it gets higher as you move to 5,000 customers. So, let's be clear, for the two reasons I've pointed to, our early experience suggests to us that SaaS will not be a less profitable business model than the traditional desktop model. And to the final concern, building SaaS products will be expensive and time-consuming. Again, stay with Sage 1. The slide shows the R&D development costs for Sage, which equate to around about £600,000. Product took about 18 months to build. And as the slide shows, looking at our R&D spend in the UK, around about 2% of our spend that relates to. Well, what about the mid-market? Well, as to cloud solutions in the mid-market, if our thinking is right, thinking sort of articulated well by my colleagues today, then that investment is akin to regular product development. So to be clear, we don't expect to see a spike in R&D as we roll out this strategy. Nor do we share the concern that building SaaS products is expensive or time-consuming. Now, you could interpret that differently. You could say, well, that must surely make it pretty easy for a new entrant to enter this market. Well, if the cost concern that was the only barrier to entry, that argument would have some credibility. But of course, as we've seen with NetSuite, as we see with other new entrants to this market, what they don't have critically is a brand, a trusted brand, nor do they have the ecosystem. Some of the numbers David referred to right at the beginning of the afternoon, 40,000 accountants recommending the product. Okay, as I said, I'd like to change tack now. What this slide shows is our free cash flow generation over the last 6 years. And it also reflects the unbroken growth in our dividend, notwithstanding recession. As the light green bars, our cash dividends show, we've regularly reconsidered our dividend in light of this very strong cash flow we generate. Now, as you know, we didn't do that for FY10. As we observed at the time, we're seeing a tentative recovery from recession. It would have seemed to us to be premature to have done that. The message for this audience today, though, is that this is something the board will keep under regular review. And of course, there's nothing about having a progressive dividend policy that precludes M&A. At Sage, we see M&A as an enabler of our strategy, the strategy we've set out in large part today. If M&A gets us to where we want to be quicker, more economically than an organic approach, then we'll look at it. Simple as that. Has our thinking changed on M&A? Well, our priorities probably have shifted a little bit. I think I must have had this conversation individually with all of you, but it's well known that Sage did not bid, for example, for Team Systems in Italy last year. There were a number of reasons for that, but one of the key reasons was the fact that what would have been a very substantial investment for Sage didn't obviously leverage our key asset, which is our existing 6 million plus SME customers. So, for this and, as I say, other reasons, we didn't think this represented the best use of shareholder funds. So, as that sort of implies, what we're very interested in is looking at additional functionality, product services, which many of them will be connected, which we could potentially sell to this large customer base. And in this regard, we're working obviously very closely with David in his new role. Of course, we'll continue to look at opportunities in new countries. We're particularly attracted to those that give market leadership, obviously. And we'll continue to look to build scale in existing, perhaps today more established markets. So with that, I'll close and pass back to Guy for his wrap-up.